Welcome to this episode of the In Focus Educational Series. I'm Candis Fitch, Portfolio Manager at IAIC. Through these educational episodes, we aim to help you have a better understanding of various topics and terminology. At IAIC, we follow 7 investment principles. In a series of podcasts, I'm going to do a deep dive into each one. In today's episode, I'm going to cover valuation-based active investment. Let's dive in. First of all, what is valuation-based active investment? Active investment is a more hands-on approach to portfolio management, and it allows us to take advantage of shorter-term opportunities. Valuation-based approach means that we're doing a much deeper analysis of the securities that we purchase. Instead of just following market trends, we are digging into companies' financial statements and determining what a fair valuation of that company would be. This includes both financial metrics, such as growing profits and cash flows, as well as non-financial metrics, such as is the management team of that company executing on the goals they laid out. We use several different valuation models to assist us in choosing quality investments. Why we believe this leads to better outcomes is that it can lessen the level of volatility caused by movement of the entire market. So by carefully crafting a portfolio of quality companies, clients don't own the entire market, and therefore the swings of the overall market don't always have the same impact to the portfolio. It can deliver better long-term performance per unit of risk. Again, because we aren't buying the whole market, we are leaving out some of those speculative companies that can be included in a market index. It enables us to accommodate client-specific constraints. So this is an important one. Although we buy quality companies using our valuation-based approach, sometimes, for example, a particular company or sector doesn't align with the client's values. We try our best to accommodate any constraints by possibly buying a different stock or something in a similar industry, or we can just completely exclude it from the portfolio. Using our active management approach allows us to accommodate these client-specific constraints. This approach also improves tax loss harvesting operations. Now, this can be a whole education session on its own, but to keep it short and sweet, our approach allows us to pick and choose individual securities to assist in tax loss harvesting. This means if the portfolio had gains in it, or there were capital gains incurred outside the portfolio, we can carefully select positions that may be at a loss to help offset that tax bill. Another example of this is our ability to pick and choose what securities go into which accounts to try to assist in controlling income levels. Now, this would not be done efficiently or effectively without our evaluation-based active management approach. This logical way of approaching investment management assists in preventing poor investor behavior because it's really the only logical approach that is inherently logical over the long term. If you have any questions on today's topic, please feel free to reach out to me or contact your portfolio manager.